And we are back with Financial Fitness Friday of the Lance Roberts Show. I'm Rich Rosso here with Danny Ratliff. And, one of the things that we talk about, we just talked about John Bogle passing away at 89 years old. These words passive and active are, I think, misused. Because to me, as soon as you touch stocks, you're active. You're radioactive. In other words, I think people equate passive to safety. And I've had investors will come to me and say, I like index funds because they're safe. And well, what kind of index funds are you talking about? Because there's how many varieties of indexing and ETFs and so forth. But if they say broad-based index, whether it's the Russell 2000, small cap, or S&P, whatever it might be, and they'll say, oh, yeah, I'm just in the total stock market. Well, why do you think that's safe?
Well,
how do you equate safe? I understand where passive in your mind might sound safe, but as soon as you touch stocks, you are an active investor. You are active. I think if you're passive, that means that you're in some form of highest quality bond that's going to mature, or you're in something else. But if you're in stocks, you've got to manage the ebbs and flows or risk along the way, depending on where you are, how much risk you want to take. Listen, if you were an investor over the last 10 years and you saw what happened last year because we lost the Fed support, okay, and the only reason I believe that you have any kind of move this year is, one, we were way oversold. But the fact is that Powell relented and said, we are listening to the market. Okay, that's what turned this around. Okay, you can come up with 1,000 different reasons what it was. But if Powell would have stayed on his path, people would have still been scared.
Oh, well, you have to be. I mean, so you think about this as a passive investor, many people were, and I see it in portfolios daily. I'm sure you do as well. Mm-hmm. And, in our experience with dealing with clients, it's been a great place to be. This buy and hold strategy has worked for many people.
It has.
If you're in a total stock market index, because what's happened over the last 10 years, with the exception of last year, the market has just ran. It's been gangbusters. It's been great.
There are market cycles where I say you got full sales up, and that's when you own indexing, right? Because the market has got this uptrend in bull markets, and you cut your costs and you get the widest exposure. And I'm out there sailing. I'm speeding along because of the fact I've got this incredible tailwind. Now, I can argue that a lot of the tailwind was the Fed. Sure, earnings were fine, and we've had major, when you look at buybacks, the fiscal stimulus from the president was great, but again, that's short-lived, and the majority of the money went to stock buybacks. But again, if you're a stock investor, you love that. If you're an employee and you haven't gotten a raise, you're not liking it. But if you're a stock investor, well, hey, that's been great. But don't discount interest rates or fiscal and stimulus or monetary stimulus triggers. Now we know they're cocked and they're ready, okay, in the knowledge that the taxpayers, without choice in the matter, will bail out or be the bailout solution. So this is the amazing part of what I see in markets. To me, they are incredibly manipulated. And even though we had a lot of volatility, Danny, I have to tell you, I was a little bit excited by the fact that maybe markets were going to go back to what they were, and the Fed was going to be out of the picture.
Well, in a perfect world, that's exactly what would happen. However, this time I do feel like it's going to be different, right? Because they don't have the tools that they had previously. They don't have this big bandwidth to lower rates. We're gonna look like Japan someday if they continue to do what we had to do previously, and see negative interest rates potentially. We're doing now. The big difference is, instead of doing quantitative easing, we're doing quantitative tightening. And so we're essentially taking money out of the economy.
Liquidity out of the system,
yep.
Correct.
So with that liquidity, typically, rates will move a little bit with that as well. And so we're going to see borrowings going to decrease, which we have seen with home and auto sales have certainly gone down.
Yes.
A lot of speculation that that's going to continue, even after we saw rates come from a high of, 3.25?
Yeah.
I think they're floating around 2.75 today, give or take, for the 10-year.
And this is where I'm going to give Lance a lot of credit. He pretty much pinpointed where that 10-year was going to peak as far as yield and pull back. Also, the fact that just as a society, we cannot handle interest rates to go too far because of we have made up our wages with credit. So look what happened when 30-year mortgage rates hit 5%. Look what happened to the national housing market overall. But what we were talking about again was indexing. And being in stocks is not passive. So when the masses are told, listen, blind buy and hold, then retail investors are called brave because they rode it out. And ride it out, whatever that means, is counted in years. So see, time is very precious to us as individuals, to all of us, right? Time is precious to you. Our lives are finite, but Wall Street lives, there's no Wall Street. Wall Street lives on forever, right? There's no finite life. So the time to break even is ignored. So if you got clients or people, say you, for example, you are out there and you are taking distributions from your portfolio and your portfolio is down 10% and you're taking 4% down, and then you're going to start next year lower, you're going to rapidly deplete your capital. And that's the issue that you have if you're going to be blind buy and hold. You've got to manage your risk along the way overall. So the point is that when it comes to the indexing component, you've got to realize that you can't be chasing. Look what happened toward the end of last year. We've had people that were, I mean, what did we have? 20, 30% in stocks, Danny?
Oh, yeah. I mean, I think we finished the year.
And if you had 20, 30% in stocks and you had bonds, which finally worked, you sort of held up. Listen, you didn't go unscathed. If you're investing in the market, there's no way you're not going to be affected.
No,
but
that's
look
exactly
at what some
right.
markets were down last year, right?
Yeah, I mean, if you look at international markets, that's the other thing about this so-called passive investing is that we're not passive investing because we're investing in so many different fields, so many different areas. And so as markets change and we get to later cycles in the economic cycle, we need to make changes. So 2 years ago, international was fantastic, right?
That's right.
And we decided beginning of the year, we need to get out. Dollar was strong. There were a lot of headwinds overseas. And it turned out to be pretty good because we look at our markets down about 4.5% last year in the overall American economy. We look overseas, international developed, down 14, 15%. Huge difference. But if you just were lulled to sleep with this passive investing idea and the idea that you need to be diversified, which I'm not opposed to diversification, just make sure you have things that do differently in different times.
So how do you define? So I wonder how people define diversification, because if I own international stocks and domestic stocks, I might, and the market's going down, I'm going down, right?
Well, I think people confuse diversification and asset allocation on a regular basis. I think it's easy to do, right?
Yeah.
So asset allocation means you're going to be in different asset classes. Diversification means you're going to be in non-correlated assets.
Right.
Right. But there's always a time to be in some areas where, like most big shops, are going to say, you need to stick in international. You're always going to be there. And you're going to tactically trade around it, right? So you may be up 2 or 3% or down 2 or 3% as far as what that holding would be. Whereas here we may decide, hey, we're going to exclude that completely because we don't think the risk is worth the reward.
Yep. The other thing I want to help people understand is bonds are very important. And the beginning of last year is if you own bonds in your portfolio, you were sort of frustrated. Actually, if you owned stocks, you were sort of frustrated because they were both acting the same. In other words, there wasn't enough fear. As money came out of stocks, it didn't go to bonds. But boy, toward the end of last year,
fund flows
that finally changed. So bonds actually did recover or did what they were supposed to do, which was to minimize risk. See, I think bonds are, for the most part, usually diversification.
Yeah,
because
I agree.
you are managing risk. Cash is a great diversifier, as well. But the one thing we have to keep in mind is interest rates matter. If you have accommodative monetary or fiscal policies that increase liquidity, that's going to be a significant stock market catalyst. Okay, and that doesn't matter what's happening on Main Street, and I think that that's what confuses everybody. Okay, so markets are characterized by this really strange counterintuitive nature that leaves investors sort of dumbfounded. You could have look what happened in during the financial crisis. People were still losing jobs. Housing was collapsing, right?
We always want to rationalize these things, right?
Yeah, but the market's already past that and looking ahead. And if it's got the tailwind from monetary policy especially, I think that it throws people off. So Look at the Depression. I always think that to me, that's a tragic slice of American history, but that to me always says a lot. So if you look at 6 weeks into his administration, FDR wasn't fooling around. He came out of this gate as this determined hand at the nation's helm. He had these convictions. He was not going to be deterred. He saw lack of ethics in business, the excesses of the 20, all these excesses were, right, the targets, right, that were his targets. He focused on them. He had the courage to expose and correct them. So the Roosevelt program was not popular. Businesses from meat packers, investment bankers, they believed that this Roosevelt program was the end for them. It was very difficult to separate these special individual or trade business interests from the interests of the citizens overall. Now, that sounds familiar, right?
It does.
So you know what's interesting is, because we always have this issue with, or this conundrum with wage growth. It was the same back then. So a big disagreement was during the Depression was, what do we do with wages? You had a majority of business leaders were advocates for reduction in wages because prices of goods were quickly coming down, right? We had massive deflation. The consumer price index fell 27%. Imagine that. We had deflation during the Great Recession, but nothing that would happen from 1929 to 1933. So less wages would have meant, hey, more bodies are employed. And this is why I want to talk to you all about this and help you understand how the markets move so differently that'll have you scratching your head as to why do markets go up, but man, I haven't seen a raise in 10 years. So we're going to talk about that when we get back. And again, you are listening to Financial Fitness Friday of the Lance Roberts Show on 700 KSEV, the voice of Texas.
Want a longer talk with Lance about your money? Request a personal one-on-one at lancerobertshow.com.